I have a confession to make. After 11 years of working in finance, I did not know how dividend growth investing worked. I knew what a dividend was. I just had no clue as to how to use dividends. I thought it was boring. I thought the whole game was buy low, sell high, and I thought that's where all the action was. Then one day, my father, he sat me down and he walked me through the math behind dividend growth investing. And then it clicked, which was soon followed by a lot of anger towards myself because I had lost over a decade ignoring the power behind dividend investing. Today, I'm going to show you why dividend growth investing gets ignored and why it's like playing 3D chess while the rest of the investors in the market, they're just playing checkers. So we're going to cover why it's ignored and why it wins. First, a 10-second refresher on what is a dividend. A dividend is money that a company pays you for simply owning a piece of it. That company, they make a profit. When they share that profit with the owners, that is a dividend. So why doesn't dividend growth investing get the attention that it deserves? First, we can point to training and incentives. Most advisors, they are trained on products, things like mutual funds, ETFs, annuities, and so forth. This is because these financial products, they're easy to package, they're easy to explain, and they pay the platform. Dividend growth investing, it's a strategy, it's a process, not a product. It's not like checking a box, and it's hard to sell in one sentence. Reason two, it's easier to sell simple stories than it is to sell true stories. Buy low, sell high, that sounds like a Disney plot and everyone understands it. Dividend growth investing, it's like 3D chess. Price goes up, great. Dividend payout goes up, great. Price goes down, still great, as long as you're reinvesting. Counterintuitive, doesn't go viral, but it works. Reason number three is the Wall Street megaphone. Large investment banks, they make huge fees through raising money for high growth companies, through things like IPOs, secondaries, and raising debt through bond offerings. Mature companies that are super profitable and cash machines, they don't raise money very often. That means for the big banks, they produce less fees, and therefore the banks, they provide less hype. Now, this isn't a conspiracy. This is just incentives. Attention follows the fees. A simple way to put it is that incentives, and I'm talking about investment banking fees through IPOs, secondaries, and bond offerings, these drive attention by both the large investment banks and also by investors that listen to those large investment banks. So why does a dividend growth strategy win? It's because you can plan your dividend income with high confidence. You can't do that with a stock price. Dividends that payment, that income is declared in advance so that you can plan on that dividend income. So how does it work? First, they have a declaration date. A record date. and then an ex-dividend date. And then finally, the payment date. As long as you own the stock prior to the ex-dividend date, you can plan on receiving your dividend payment on the payment date. Now, stock prices, they'll wiggle up and down. The declaration of a dividend and knowing that you have to be in before the ex-dividend date allows you to plan your income to receive payment on the payment date. And being able to plan your income using dividends, that matters, especially in retirement, where sleep is much more valuable than suspense. So let's get into the meat of it. With dividend growth investing, there are 3 ways to win. First is the most obvious. The price of the actual stock, it can increase. Business is good. The market recognizes that this company is performing well. Stock price goes up. That's great. Win number 2 is that the dividend payout increases. What happens many times is that dividend paying companies, when they're doing well and are growing their profits, they will increase the dividends that they pay their investors. Say company A is paying an annual dividend of $1 and they're having a great year, business is looking good into the future, and they decide to increase that dividend payment to $1.10. You just got a 10% pay raise without buying any more stock. Now, companies that have a history of increasing their dividend payments over the years, that is not a guarantee of a continued increase in payments, but it's a very healthy signal. Now, win number 3, it's very counterintuitive. You can win when prices go down. That's right, when prices go down, as long as you reinvest those dividends. And when we do this, it's called a DRIP program. D-R-I-P. What that means is Dividend Reinvestment Program. So let's do some quick and easy math to show you how a DRIP program works. We're going to take this fictional stock, Acme, which is trading at $10 a share on the stock market. And each year, they're paying $1 in dividends. We decide to invest $1,000, and that's going to give us 100 shares. Remember, $1 dividend. So year 1, that 100 shares is going to give us $100 in dividends. Now we take that $100 and we're going to reinvest it and buy more shares. So we buy 10 shares, which gives us a total of 110 shares. Right? Now year 2. We have 110 shares. We get $1 in dividend. That's going to give us $110 in dividend income. However, the price goes down to $5 a share. What happens? It's like a 2008 crisis situation. Market pushes prices down on all stocks. Nothing is wrong with Acme. Everything's fine with their business. But the price is now at $5 a share. We now have $110 to reinvest. So that's going to allow us to buy 22 shares. That's a total of 132 shares. Now year 3, We have 132 shares. We still get $1 in dividends. That means we're going to get $132 in dividend income. But the price, it has recovered. We're back up to $10 a share, which means we can only buy 13 more shares, which is a total of 145 shares. Now, what is the result of this price dip over these 3 years? We now have 145 shares. So now our dividend income is $145, whereas before it was at $100. Our account value is now $1,450, whereas it started out at $1,000. And this all happened after the price dropped 50% and simply recovered to where it should have been trading, where it should have been valued in a normal stock market. So this is how you can win with the stock price going down, because you're buying more shares automatically on the cheap, and it allows you to increase not only your income, your dividend income, but also your account value. Lower prices allow you to buy more shares as part of the DRIP program, and more shares create more income and more account value, and that's what we call the snowball. Let's kill a few myths so that you don't leave any money on the table. Myth number 1 is that dividend stocks are boring and they don't grow. Some are boring, but how boring is it if a company continues to increase their profits and continues to increase their dividend payouts? Myth number 2 is that this is too good to be true. It's not magic. It's math combined with patience. What's the catch? The catch? Well, you have to go out and find and buy companies that have a very healthy business. You need to diversify, and you need to have patience and discipline when the market throws a temper tantrum. Myth number 3, I'm going to miss those rocket ship opportunities where stocks just go to the moon. Well, with dividend growth investing, you'll also miss the 50% declines while you hope and pray for a rebound. They're just different games, and you might want to pick the game that allows you to stay invested and allows you to sleep at night. Now, some caveats just to make sure you don't get wrecked. You have to do your homework. History of increased dividend payouts, that's great. We also have to pay attention to cash flow and payout ratios. Dividends are not guaranteed. They can be cut. This is why it's important to diversify. It's also why it's so important to pay attention to the business fundamentals. The DRIP program, the dividend reinvesting, that is completely optional. We use it when we're building up our income, and then we stop using it to varying degrees when we start taking income to live on during retirement. Nothing that I've shared today is a guarantee. Dividend growth investing is a framework that stacks the odds in your favor. And it's this framework that stacks the odds in your favor that has me call dividend growth investing 3D chess. While the rest of the world, all the other investors, they're playing checkers. So why doesn't dividend growth investing get the attention that it deserves? It's not shiny, it's not a product, and it's not easy to hype. Dividends allow you to plan for income, get pay raises, and turn downturns into more future income. That's 3D chess. If you want help building a dividend first income retirement plan, Down below in this video, in the description, there's a link for a 15-minute fit call. If we're a good fit, we can talk about possible next steps and go from there. Like and subscribe if you enjoy this no BS, simple, straightforward, income first education. This is education, not investment advice. Before making any investments, be sure to talk to a licensed professional such as myself before making any decisions. Thanks for watching. Go build the snowball.